demographics is not going to be the great savior. And since you brought up Ivy, they've done that. They've done the analysis. The growth rate of millennials in their prime home buying years is about 1.2%. At the same point in time, when baby boomers were coming into their prime home buying years, that cohort's growth rate was 4.5%. So
interesting.
Just net out anything going on in the economy right now in terms of the growth rate of the economy, the underlying demand for homes, it's a quarter of what it was when baby boomers were coming into their highest earning years and buying homes. But on top of that, you've had this GSE imposition of higher fees to buy second homes. And I was kind of astounded at the simple number, the sheer. When you think of simple homes, you think of really wealthy people who are going out and buying vacation homes for cash. I was apparently very wrong about that. They're going out and taking on a second mortgage because that makes sense, right? I guess it does. But since these GSE fees have been imposed on April the 1st, we've seen second home sales crash. Now, at the margin, that's what you always want to be focused at. What has been one of the key drivers in the current housing explosion? Second home sales. Mr. and Mrs., we're going to leave our place in Chicago. We're going to go buy a mansion on a lake somewhere, and we're just going to live out COVID. We better winterize it while we're there. Oh, now that it's winterized, I really like to live here, but wait, and I've got 2 homes. So, and my stock portfolio has gone to bleep. And so now it's time to choose, which one do I sell? So my point is, because the GSEs have imposed this fee, we've seen literally a crash, look back at Redfin, a crash in second home sales. On top of that, the wealth effect, the reversal of the wealth effect on the stock portfolio is going to have many wealthy Americans looking and saying, which of these 2 homes do I want to pay for all the maintenance, property taxes, insurance, everything, upkeep on, and mortgage payment, by the way. So I think in a year's time, we could be talking about an oversupply issue, especially if you tack on the fact that we're constructing more single family homes since we haven't any time since 1973. Oh, and by the way, the multifamily pipeline is jammed full.
Right. And isn't that crazy? It's very similar to the jobs market, where right now the narrative is way more openings than there are applicants to fill them, right? And you and I have just given a litany of reasons why we think that's going to flip very quickly from a jobs glut into a jobs drought. Housing market's the same thing, right? All we've heard for the past 10 years is not enough inventory. That's a fundamental reason for why prices are fair at these crazy, rates, because there's just no inventory out there. That, I think, is also a flawed narrative. And you just made a number of reasons, and I agree that it's not inconceivable that we could have a housing glut not too long from now.
No, I mean, we've never seen this type of this violence in 2 metrics: the National Association of Home Builders and buyer traffic. We've never seen monthly deltas like we're seeing, and we've never, back to 1999, we've never seen 2 back-to-back months in National Association of Realtors existing home inventory data with this big of a buildup over a period of 2 months.
Yeah. Yeah. And you know what? I mean, everything that you just mentioned, you didn't even mention recession in there, right? Like if we go into a recession where there's lots of layoffs, I mean, that completely compounds the situation, worsens the situation even further, right? But you don't need the recession to have, the issue that you're forecasting here. Gosh. Okay. So.
And Jay Powell wants to break housing. It is the egg on his face. It is the ultimate egg on his face, because he can sit there at the podium all day long and say, oh, look at energy prices and the war in Ukraine, and oh, look at food prices and you can't get fertilizer. And woe is me. I didn't cause any of this. You never hear him mention housing, because he did. He's the one who fed the speculative fervor in housing. The housing inflation in many ways lays at his door. Would all of these private equity investors, who make up 1/3 of the market right now as investors with all cash, would they be as flush as they are had interest rates not been at the zero bound as they have?
No, absolutely. And it's been, so when I've had Ivy on, I've talked with her about the dramatic increase in investors buying in the residential market. And as you said, the fastest growing cohort of those investors, still a lot of mom and pops out there, but have been these institutional buyers, right? And it's no competition, right? We hear of all these all cash offers that come in way above asking. These guys can make those bids because they're flush with super cheap capital that no regular person can compete with the rates that they're getting, right? So,
and this is why I say, when there are pitchforks one day, I mean, they're going to figure out that the GPs walked away with every last penny, and the LPs were the ones who were left out in the cold.
yeah. Yeah.
Namely my mom's pension. It's going to be one of those things where they're like, what do you mean 2 years ago CalPERS couldn't quantify the fees that they were paying to private equity?
Right.
And they got away with it.
I didn't want to wade into pensions just because it's such a big topic. It's not fair to just sort of give an offhand comment about it, but I'll connect one other dot there, which is, regular people got screwed because housing prices got driven up to unaffordable levels. These guys who were getting super cheap debt enabled by the Fed, they got great returns. To your point, they're now sort of slinking out the back door with all the money, letting the pension funds and whatnot be the ones to have to deal with the aftermath. Now, when that pension fund has to, then you're going to have the pension fund need to be bailed out. And I was just talking about this the other day. I see a social schism growing. And I'm not trying to make a judgment call whether it's good or it's bad. I just see this friction coming, which is, if you have a pension right now, it's like having millions of dollars in the bank, right? That are paying you, a dependable income for the rest of your retirement, right? A ton of people out there who don't have a pension, right? Who worked hard, saved hard. Even if you did great. You saved a couple $1 million up. With yields today, you're not getting anything off of that. And then of course the markets are correcting. So you're losing, a fair amount of what you saved up right now. And to have the insult of then having to have your taxes increased to bail out somebody's pension when you don't have one, it's going to pit neighbor against neighbor, those with pensions, those without. I see you nodding as I'm saying this, but it's just such a
it's only because
cluster,
I pitched this as a book 2 years ago to my publisher, Penguin Random House, as a sequel to Fed Up. I pitched neighbor against neighbor as a theme because of when pensions blow up and other people are made to pay their taxes. I actually wrote a whole write-up on it, and if I had the time to write a book, I would. But I
knew I liked you, Danielle.
It's a thing, and it's going to be a thing, especially as we see murder on the subway. And I don't say that lightly, but especially as you see this impetus to continue hollowing out Illinois and the coasts, where there's no rule of law. And so you're going to have more and more and more of the US population moving to where they feel safe and where they feel like they don't get gouged for taxes. But at some point it's going to become a federal issue.
Well, and that then opens up the door, and we don't have time to get in all this, especially because I have a couple other key questions to ask you. But then, do you start having like state bailouts?
That's right? What I'm talking about.
Yeah. And what's
Pat Cooney actually instituted the legislation to begin with, because he didn't want for a Democratic-run Congress to do a blue state backdoor bailout using one of the Fed's municipal bond facilities. He didn't care about high yield and LQD at the time. He didn't care about high yield and high grade. That was just a bonus. But he still turned all the credit facilities off at the same time because he didn't want a blue state backdoor bailout.
Yeah, well,
too much information. I know.
I'm sure that's still not going to thwart them from trying their hardest. All right. Well, look, so many questions, but let me zero in here, and I'll try to land the plane here because I know you got to get on the plane relatively soon. Let's just get to the market outlook. So, we got a lot of people watching who are trying to navigate, these markets. It's now been a rocky year. The outlook looks, murky. I'll be, kind at this point. What do you see as more likely to happen from here? Do you see the uncertainty, the volatility, maybe even the downward trend continuing in the general markets, or do you see something different?
So, we're not even, if you're talking about the broad averages, we're not even at the average decline in a recession. And we have to bear in mind the backdrop, and that is consumers are still consuming. Credit card debt's going through the roof right now.
Yeah.
The stimmy lifestyle, Americans don't want to give it up anytime soon.
People haven't downshifted. They're just shifting the financing of it from the checks now to the credit card companies.
Exactly. So if we saw a negative print in Q1, and if we're in the middle of an industrial recession and Q2 should be an earnings recession as well, then what's to say that what we're experiencing is not going to be longer and more drawn out than what we're expecting going into a midterm? I just don't see it's feasible that you can say with any certainty, as malleable as he is, and everybody on my Twitter feed says it all the time, he'll pivot, he'll pivot, he'll pivot. I'm not so sure. I'm just not so sure. And even if he does, he can't go at it alone. We saw this in the post-pandemic world. You require right now to bail out the markets if they decide to throw up. And by the way, what we've seen so far is nothing. But if markets decide to truly get upset, you need a combination in equal forces of fiscal and monetary stimulus. And we ain't getting that before February. Not happening. So no, I don't see that there's any, we can have technical rallies, we can have passive fund flows that create earth-shattering rallies on any given day. But in the end, I think the fundamental narrative is too strong, and we're not there yet. We're not technically quite in recession yet for us to be able to say, all clear with the stock market.
All right, great. And that's very complementary to a lot of the recent guests I've had on this program, where we've kind of gone deep into market dynamics. Many of them saying we're nowhere close to a bear market at this point, even though technically the S&P, briefly dipped below the 20% level on Friday, last Friday. But just sentiment alone, right? There's still so many people who are lined up to kind of, buy in. Is this the next, where the next bounce comes, and I can ride up the next wave here?
Corporate insiders have been buying their stock back. They think Powell's coming to the rescue.
Right. And in a real bear market, nobody wants to touch a stock ever again, right? It breaks your faith. It breaks your confidence. We're just still nowhere close to that yet.
Nope.
All right. So given that outlook, are there any asset classes that you either like in particular or dislike in particular right now? I'm going to guess you like cash right now, given some of the uncertainty.
Boring, but true. And I did mention, I have mentioned gold. What I don't like are industrial metals right now at all.
So copper, zinc, all that stuff.
Iron ore, you can always not like that stuff, because I don't think that China's coming to the rescue like they did in 2015 and 2016. Yep. So be careful of any commodity super cycle narratives. That just means that we're Joe Q, huge investment bank that's built up our commodity trading operation. So we want to keep that narrative going. So be careful there. And by the same token, again, I'll reiterate, look, I'm not old enough to be saying it, but municipal bonds have had the what kicked out of them. And I think that if you can find opportunities there, that would be money good. And other than that, you better be staying short, and be careful of energy as well, because everything that, every pendulum always swings back the other way. So be careful, because right now there's no demand destruction being reflected in energy prices. Right.
And I love energy as a long-term play. Mm-hmm. But Danielle's exactly right. First off, when you have these massive moves in any asset class, but commodities particularly, they tend to have violent corrections, and that's for a variety of reasons. One, they just get overvalued, right? And that has to correct. Two, it's kind of like farming in the sense that if you have a crop one year that everybody likes and they bid the price up for, well, every farmer plants that next year, right? So when the price goes up, you encourage a lot of exploration and development and whatnot. And it takes a while to come online in energy. So I'm not trying to, say they're just going to invent a whole bunch of oil wells in the next couple of months. But with all the demand destruction in the recession, outlook that Danielle and I have been talking about, that does mean the economy will use less energy going forward. So, I like energy a lot, but I think Danielle's giving a very realistic point, which is don't bet the farm on it right now, because there may be, a nearer term price correction. All right. So just talking about munis for a second, because I know you have liked them in the past. The beginning of this year has been
thank God I'm a buy and hold when it comes to munis, and I only own individual bonds because it's not been fun. But I've just been sitting back watching, just clipping the coupons.
So this has been a bad year for all bonds. So munis aren't it's not just munis. I just want to underscore, for you, it's specific kinds of munis, right? I mean, you're saying go find kind of like the A grade, municipalities out there don't just throw a dart and pick any muni here.
No, I mean, there are fabulous reports. They tend to be annual reports, but there are fabulous reports that walk you through which states have the lowest exposure to alternatives, which states run their pensions the most conservatively, which states don't necessarily issue bonds to cover up pension underfunding. There are plenty of them out there where there are rational people running the show, whether it be a state or municipality. So there are places to pick and choose. Ask around, ask around in the financial community. There are great managers who just specialize in municipal bonds.
All right. And one of the main reasons I asked that is, as you know, Danielle, Wealthion has recommended financial advisors that they connect people with to help them kind of navigate all of this. I think sort of finding a good muni bond is something where a good experienced financial advisor can be a really helpful guide, right? And those guys, they're going to come on in just a few seconds after we're done here, Danielle, but I wanted just to plant that seed in folks' brain. Sure. All right. So as we begin to wrap things up here, Danielle, two quick things. First off, for folks that have really enjoyed this conversation, they want to learn more about you and your work, they want to follow you, where should they go?
Well, come to my Twitter homepage right now. Come to where my pinned tweet is right now, because we've just launched an anniversary promotion, and this is shameless on my part, but you get the first 3 months of the Daily Feather for half price, and you'll never, ever go back to anybody else's research. I will toot my horn. It is the best. But we're in the middle of an anniversary.
It is the best.
It is the best. It is. And our QI Pro is even better, but come to my Twitter feed, because I've got a pinned tweet that'll take you exactly to where that promotion is. And if you don't follow me on Twitter, then you clearly need to get out more, or follow me on Twitter, and then you can stay in.